This is my argument against companies going IPO. In this article on Forbes.com, written by Robert Mancuso, titled simply "Don't Do an IPO." In this article, he brings up a statistic from the Dow Jones Private Equity Analyst 2009 Guide to the Secondary Market. According to this guide, 85% of the 76 companies that went IPO in 2007, they're today trading below their IPO price, which means that most of the original investors, uh, what he calls original constituents in these capital structures, they did not exit fully at all at the time of the IPO. Uh, Robert Mancuso in this article says that IPOs are supposed to sparkle and impress, but once they stop growing, people lose interest. If the growth flattens or is interrupted by a down quarter, the consequences for the company are very severe. As the stock price falls, its value as a traded currency, which is one of the principal reasons to go public, is questioned. And if it continues to fall, management stock options lose their ability to motivate existing management and encourage new hires. He also mentions another point against companies doing IPO is that the burden of public ownership, uh, such as regulatory compliance, the risk of lawsuits, being targeted by activist shareholders or proxy fights, can often overwhelm the benefits of an IPO. And another article written by Elizabeth Wasserman on Inc.com, she lists many reasons for not doing an IPO, such as loss of control over the company for management and founders, pressure to meet earnings estimates of research analysts that will make it more difficult to manage for the company's long-term growth. And she also brings up the point that SEC requires public companies to reveal a lot of information, and sometimes these informations are very sensitive, and the company might not want to reveal if it wasn't a publicly traded company. Another supporting argument against companies going public comes from this article on McKinseyQuarterly.com. It's a debate on public versus private ownership. And in this article, a statement from Leonard Sundin, who's the president and CEO of Sanitec, a private equity-owned company. The advantages to a private company is that they don't have to wait for the next planned board meeting. They don't have to communicate to a wide range of investors, which a publicly traded company does, and it doesn't need to tell its competitors anything if it doesn't want to. And also, he mentions that a public company has exposure to risks in the public exchange, such as speculative investors, which can influence the company's stock price.